Welcome to the Heroic Investing Show. As first responders, we risk our lives every day. Our financial security is under attack. Our pensions are in a state of emergency. A single on-duty incident can alter or erase our earning potential instantly and forever. We are the heroes of society. We are self-reliant and we need to take care of our own financial future. The Heroic Investing Show is our toolkit of business and investing tactics on our mission to financial freedom.
Hello and welcome to episode 167 of the Heroic Investing Show. This is a podcast for first responders, members of the military, veterans, and anyone looking to improve their financial future and gain some freedom with their time. We teach America's heroes how to build passive income, build their startup business, and safely grow wealth through real estate and other time-tested alternative investments. My name is Gary Pinkerton, and I co-host the show with Jason Hartman. And today you get to hear Jason talking with Salvatore Buscemi. And Salvatore is an expert with pooling assets, syndications, putting funds together, and he dives down into, he's written, some books on the impact and the recent recession and real estate correction from people raising money and being a private lender, being a hard money lender in a situation where they didn't know what they were doing, lending money inappropriately to mortgage brokers and individuals that also didn't know what they were doing. He brings up some really good points, I thought, of things to look out for when you're considering lending money in alternative investment arena. So, one of the things about, I'm not a fan of securities. I'm not a fan of the SEC and the oversight that comes with that. It certainly has suppressed some of the fraud that happens on Wall Street, but that is just an area when it's so easy to move money, liquid money, and when it's an environment where they've convinced the investor that, just don't ask questions, send us your money, you're in it for the long haul. We're the professionals, we'll take care of the money, right? So it certainly is a place that's ripe for that kind of fraud, of Ponzi schemes, of just misappropriating and misusing money. But I guess my point there is that the SEC is really needed, right? So when you go to alternative investments, when you're provided the opportunity to invest in somebody's apartment building, in their land development, in their business, or something that's what I call alternative, things that are alternatives to investing with funds, hedge funds, things like that on Wall Street, paper assets. So when you get into the alternatives, you buy into an oil and gas exploration syndication. You don't have that same kind of protection from an oversight committee with the mountains of paperwork that does exist with paper asset investing. So it is certainly incumbent on you. I've made mistakes there. I've lost all my money in some investments. And so I pay very close attention to who I'm investing with, what their experience level is, talk with, just do a lot of due diligence, talk with previous investors. And there's just a lot of people out there doing this. So if there's any indication at all that you have concerns, any spiny sense at all, tingly sense, hairs on the back of your neck, then just step on to the next one. No matter how good it looks, another one just as good is going to come along. But if your gut's telling you anything at all about negative about an investment, walk away from it. That's my biggest and best investment advice for you. So anyway, so in this one, Salvatore, he comes up with some really useful and helpful things, some excerpts from his book that I think will also probably apply to crowdfunding for future things. This article or this interview was over a year ago, and I'm actually surprised that we haven't had more problems already with crowdfunding, that more abuses. In the main, it has been fairly timid, at least as far as I've seen in the media and what I know of personally that has gone on with crowdfunding in the real estate space. So maybe it is a little bit more protected and controlled. Maybe people are more savvy than I gave them credit for at the beginning. But Jason makes a comment that he sees a lot of litigation and fraud happening, and I haven't seen that come to fruition yet. And I was of a like mind of that when I first heard this come out over a year ago. So I think you'll appreciate what you hear from Salvatore. This is really some good nuggets in here that you should keep in mind before you kind of go into what is the Wild West, which is investing in alternative type things. Direct buy and hold, being the direct investor, certainly has an advantage when it comes to getting taken on a scam by investing in somebody else's business. But please don't misunderstand that I think all syndications are poor use or risky use of your money. I don't think that. I have 20 properties now, 30 units. I can tell you that the complexity builds very quickly when you're a direct buy and hold investor. So am I done with single families? I don't think so, but I'm not going to have 300 the next time we talk. So I am looking into larger properties, maybe direct ownership, maybe a mobile home park or self-storage facility or an apartment building. But I'm also not opposed to participate in syndications. I've done it before. I've learned some lessons and I'm still doing it. So I think a good balance exists. And Salvatore has some great recommendations here. So please do enjoy, and we'll be back with an original episode next on 168. Thanks so much. And let's listen in with Jason getting some great advice from Salvatore Buscemi.
It's my pleasure to welcome Salvatore Buscemi to the show. He is managing director of Dandrew Parnters and co-founder and CFO of Oasis Fractionalized Real Estate Equity. He's author of Making the Yield, Real Estate Hard Money Lending Uncovered. Sal, welcome. How are you?
Thank you very much for having me. I'm very happy to be here. Thank you.
Give our listeners a sense of geography. Where are you located?
Right now I'm in New York City.
And is that where you're based?
Yeah, we're based in New York. We also have the Oasis Fund is based actually out in Las Vegas.
So hard money lending uncovered. It sounds like, is there a scandal there? Hard money lending uncovered.
It is, and back during the past, housing boom that we had, there were a lot of people who were getting involved into deals, or they were pooling money to invest in what we call private loans. And what happened was that a lot of these people did not know who they were dealing with, and as a result, they wound up losing a lot of money because essentially they were lending money to people who they didn't know, who didn't have an alignment of interest with them. And also, lastly, they didn't really know if the person who was borrowing the money, the operator, actually had any experience. And so we're starting to see this happen again in certain other parts of the industry. You and I spoke about crowdfunding. And people have a strong interest right now. People are they're desperate for yield.
It's sort of the hot new thing, I'm sure there will be many problems in the world of crowdfunding, many lawsuits, many frauds. Get ready. They're coming.
I'd love to discuss this. And really what's happening is that you can't take someone $1,000, $2,000 from someone and really place that capital meaningfully.
Before we go into the crowdfunding thing, and I really do want to dive into that, let's just finish on the hard money lending issue. So you talked about the last housing boom and bust. Were you talking about people who were making direct loans or pooling money into a fund that was making hard money? Well, which one? That's different.
These are people who are making direct loans. So they would have a brother-in-law who was a mortgage broker. If you're in Southern California or, in the Southwest, and the reason why we have the Oasis Fund out there, everybody was a mortgage broker. And then people are saying, hey, you know what? I have a few bucks. Why don't I give you $100,000? And it's asymmetric. So the broker is going to be great. I'm going to take my 5 points off the top. And if anything goes wrong with the loan, it's not my problem. So, a lot of these people were brokers who thought that they were becoming money managers. There was a lot of interest in this because yields are low, right? Rates of return are very low. So this was attractive where people were getting a, quote, guaranteed coupon each month of 12 to 15%. The problem is that only works if you're lending to a qualified operator or borrower, right?
An operator meaning now, usually this borrower was who? They were someone who was flipping houses?
So in the best case scenario, yes. At worst, they were owner-occupants facing foreclosure, which opened a whole new other set of, a whole other Pandora's box of problems.
Okay, so these mortgage brokers were out there saying to people, hey, look, I've got all these borrowers that I can't get a conventional Fannie Mae, Freddie Mac type agency loan for. But, would you be interested in loaning them money? And they would just say that to a regular person, right? Just an individual that they knew, a friend or a family member maybe, or a client. And then they would loan someone in pre-foreclosure hard money to get out of foreclosure on those were usually second trustee or even third position mortgages. Yeah.
Which is even scarier, but yes, you're dead on with that. That is correct.
So what kind of rates were they promising?
They were promising 15. They were as high as 15. they would go as high as the law would allow them to, usury laws. But
so a lot of these deals, they were just lending at the peak of the market. They were, not enough equity. What was the problem here? Or if they were a home flipper, when you say operator, that's probably what you meant. And they were a home flipper and they got, caught with their pants down, so to speak, right?
Here's what happened. When the subprime loan machine stopped issuing loans, that's where the house of cards fell, because there was no exit strategy for these investors or private lenders to get out, and that's what caused the problems. Phoenix, Las Vegas, those very hot markets, people who were marginal buyers were getting 125% loan to value using a subprime loan. However, when those loans dried up, guess what? People were holding the bag, and that's what caused prices to drop. You can't give someone 125% loan to value in a hot market and not expect something bad to happen. And that's what happened to a lot of these hard money lenders, is that oftentimes the appraisals were inflated so that it would justify more money, meaning more fees into the pocket of the mortgage broker. Does that make sense?
Yeah. Okay, so certainly, many people have been burned, but these were direct loans. They weren't funds, right?
They were. It's interesting you bring that up. The reason why we have the Oasis Fund out in Las Vegas is because that was a triage fund that we set up to buy out hard money funds facing receivership, fraud, all sorts of other issues.
Okay, so these are funds. So you set up a fund to buy other funds?
Yes, facing distress. That's correct. And this is the mess that we saw. And it is terrible. There people were, you as the private lender, some of them were direct loans, some of them were through a fund structure, a typical LP or LLC structure. And what happened is that sometimes you would be told that they're lending on a single-family home, but now they're doing development deals. The person doesn't really have the experience to be doing a development deal, and these loans would be made outside of the core broker's, area of expertise, his what he specializes in the sub-asset category for real estate.
Right. Yeah. Okay. All right. So that's what happened. I'm just not a fan of funds because these fund managers, they can just do whatever they want. They're one day they say they're going to do, lending on single family homes. Then they're suddenly doing a development deal, as you described.
It's terrible. It's terrible. And that's the novice. Institutionally in New York, and people who I grew up with on Wall Street or Goldman Sachs, they're very good fund managers. But you have to be careful of the people who tell you that they'll do anything and give them what we call 100% discretion. When you're giving them a blank check and they can do anything they want, that's where the problems come in. And a lot of these fund managers have come in, and they were, promising all sorts of returns and fees, but they just didn't have the dexterity or the experience to do that. And so you wind up, these guys feel as though that they can take the risk. They want to be the next Donald Trump, swinging for the fences, and that's where all the problems happen.
It's easy to swing for the fences when you have someone else's money with which to do it. And, worse than everything you mentioned is a lot of times the fund managers are just crooks. They're just greedy crooks. They're just basically ripping people off.
It is true. But even worse than that, and I'm sorry to go back to the crowdfunding, but you're starting to see this happen, is that real estate's allure as a wealth creation tool relies on the fact that it's very inefficient, right? And it's inefficient because it has a human element to it. And if that human element cannot perform, that asset is going to not perform correctly. And so now you're starting to see people who want to get into real estate. They see that there's a lot of money out there. People don't trust the stock market. They don't understand it, but they also need coupons. They need monthly cash flow coming in. And so they're going to real estate fund managers who really have no experience whatsoever in this space. Just because someone worked for 10 years at PepsiCo doesn't necessarily mean that they're a real estate entrepreneur. They've always had top cover from the parent. They probably have no real estate experience. They've never had to manage a P&L, and worse yet, they've never had to lay in a pool of their own sweat. And so that's why it's so important that when you do qualify these fund managers, and there's many of them that are very, very, they're very adept and very sophisticated, is that you have to look at their track record. Have they done this before, or are they a computer software engineer who says, hey, this is a great time to get into buying apartments right now?
Yeah, right. It's unbelievable. Yeah, I know.
No, that's what you're talking about, though. They're not just crooks. They're not all of them are crooks. They're inexperienced, and they prey upon their friends. Like, hey, he's a good guy. I've known him for a while. He's great. I go to church with him, or I'm in the Kiwanis Club with him or something. But that doesn't, people are investing in a person. They're not investing in the deal because the investors don't know anything about how to value a deal or what it looks like. And a lot of times these syndicators would go out there and they would just bid up because they were making fees, but they would just bid up the asset. And that's where a lot of them came into problems, is because they were overpaying for stuff that they didn't know what they were doing. I'll give you a quick example. There was in our fund, we had to bail out a team of, you're not going to believe this, plastic surgeons from Southern California who bought an apartment complex in Texas, and they bought it at a 1 cap. They overpaid for it because the broker told them that pretty soon, Texas, apartments are going fast and they're going to be priced the same as they are in California. Of course, location is really what dictates, the supply, demand, and pricing of this housing stock. And they wound up overpaying because they got hoodwinked by someone who did not have an alignment of interest with them, someone who was going to make a fee on the sale, not necessarily be there and be a good manager. And that's what happens, is that people just don't understand what they're buying, and then they mismanage it, and then they fire the management company. So now the Indians are in charge of the reservation. There's no chiefs around, and that's really where you see the distress. It all comes down to the human component to it, which is why I love real estate, because somebody's always screwing up.
Yeah, right. And that is what's great about real estate, and why I love it too. It's an imperfect market, and that imperfection is what breeds opportunity. And yeah, no question about it. So, one of the things I say is that I have this 10 commandments of successful investing, and commandment number 3 is thou shalt maintain control. Because when you're not a direct investor, when you don't maintain control, you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with an idiot. And number 3, assuming they're honest and competent, they take a huge management fee off the top for managing the deal. So you made the comparison, which was a good one, about the people on Wall Street who could be good fund managers, the Goldman Sachs, et cetera. And, they may be good, but they take such huge management fees off the top of the deal. Is there any way to win here with these funds?
It's you have to read the docs. You have to know.
But even if you read the docs, they don't have to follow the docs, right?
Well, they do. When things go problematic, they all go back. I mean, the operating agreement is really a prenuptial agreement. That's really what it is.
That's a good way to put it. I like that. Yeah.
Yeah. Nobody reads it until the divorce happens or something blows up. But not everybody in these funds pay what I call rack rate. There's a lot of people in these limited partnerships, for example, and they are, but their allure is that they're able to get you into deals and invest alongside qualified people and other sophisticated investors who you would never be able to invest with anyway.
Well, wait, explain the rack rate thing. You didn't really explain what you meant there.
So, think about it. You're flying from Phoenix to New York. The guy next to you bought his ticket on Orbitz for $280. You paid $580, and the person, in the aisle in front of you paid $900. He bought it yesterday. All these investors sometimes don't pay the same fees, and their incentives are different. And that's the secret that nobody really knows in these funds is that not just because the docs or the terms or what they're offering isn't necessarily what is going to happen, and that's negotiable.
So in other words, I want to make sure people really get what you're saying there. So if a fund comes to you and says, "Hey, I've got this LLC we've set up, and we're taking on investors to do this deal, whatever the deal is." Okay, they do that, and they say the minimum to invest is $25,000 or $50,000, and that'll buy you 1 share. Okay, but and then they pull out a list, or they drop the name, hey, I've got so-and-so and so-and-so has also invested. And suddenly, there's that social proof element. So you think, oh, well, if, so-and-so is in, this must be a good deal. Here's my money, right? But what you don't hear is that so-and-so, that name that they just dropped on you, that person maybe got a free share, or they just got their share for half price, because what they did is that, that wealthy guy in town that everybody knows, they just wanted to get his name on board. That's basically like a celebrity endorsement, if you will. Maybe it's a small local celebrity, but it's someone and respect, right?
Well, let's put it a different way. If Warren Buffett invested in your fund, but you weren't going to make any money off of his investment as a fund manager, would you take his money?
Yeah, because that would be great for my brand, right?
Absolutely, because you'd be screaming down the street that Warren Buffett's in your fund, and now everybody's going to dogpile into it. So you're absolutely correct there. Absolutely.
Okay, so that's the rack rate issue. Anything more you want to elaborate on that? That's very interesting.
I'd like to hit on the experience, and I'm very scared today. What I'm seeing with crowdfunding is that people have, embellished resumes or something. The guy who's doing knocking tin, putting together houses, does not have experience to manage an asset, a multifamily asset overseas. The operator should always be local to the asset, always, unless it's some sophisticated, huge management team like a Goldman Sachs or something like that. But if you're dealing with these mom and pop retail, the rehabbers, the retail investors, the retail guys we call them, non-institutional, I would be very scared if they say, I got a great apartment complex, it's 90% occupied and it's in Columbus, Ohio, but we're in Phoenix, Arizona, say. That's a problem because that's a very difficult problem to manage. That's very important.
Right. Yeah. I agree. And especially when they're doing, intricate rehab. I mean, almost every apartment deal, every multifamily deal includes rehabbing the units, increasing rents as the units turn. I just did one myself. I just closed on a apartment complex that I went in on with a client of ours, 125 units, owned it for like 3.5 years, rehabbed. But see, there we had a general manager, and my partner and I now say, we never want to deal with a general manager again like that, because they were just double, at least we thought. Of course, we had arguments about it, but we just felt they were like double dipping everywhere you looked,
Yeah, they were. But here's the other thing too, is that do they know what they're doing? And you bring a great point on.
They didn't then. They learned a lot on our dime, so we gave them an education.
Yeah, you became the research and development
exactly. We were the R&D.
Yeah,
right.
Yeah. So this is funny. So we see these deals all the time, and I'll ask them, what are the sources and uses for? And they'll say sources, Dandrew, uses by apartment. Okay, but what kind of repairs are you going to be doing? There's real value-added repairs, and then there's repairs that don't add any value. Everybody who moves in an apartment automatically assumes that they're going to have a light bulb and a toilet seat, right? That's not value-added. That is maintenance, that general maintenance. But what they don't expect is maybe to have like a part-time concierge in the lobby, or a newly paved parking lot, or 2.5 horsepower whirlpool tubs in the bathrooms. That's real value added. That's attractive to the tenant. So when you talk to these guys, they're too busy dealing with like the muck. They don't know where to start first. And sometimes, a lot of these value added deals will blow up because they didn't know what they were doing. They were doing things that were more maintenance rather than value added. And by the time they get to the value added stuff, they were already out of their slush fund.
Right. Yeah, absolutely. Okay. What else?
I'd be very wary of crowdfunding. If we can talk about this now.
Okay. So now make the distinction though. We started with the hard money lending, and then we sort of went into, like, we talked a little bit about direct hard money lending. Then we went into funds and how you rescued funds, and also, funds to just buy deals, or LLCs. I don't know. It's sort of all one and the same, really. It's kind of like, I mean, make the distinction for the listener, if you would, as to if there's any difference there, and then why is crowdfunding different? It's basically the same kind of legal vehicle. The structure is not different. It
is, but the problem is that the crowdfunding today in real estate is, what we were talking about with these funds were minimum investment, $50,000. You have to be accredited. Okay, whatever that means, accredited today. That definition changes. Got a little tougher after Bernie Madoff, but now all of a sudden, because of the Jobs Act, people now can get in who maybe aren't accredited. And so you don't know if they're dealing with their last $1,000 or not. So they don't have the sophistication. So now you're dealing with investors for as little as $1,000 can get into this multifamily deal. If you've done any sort of partnership whatsoever, you know that just to paper the deal and do the accounting costs about $1,000 an investor to do that. So how is that money actually going to be used to provide value for you as an investment? That's number one. Number two is, anyone with that kind of small money generally is not sophisticated. And that means that these fund managers who are now trying to crowdsource or crowdfund a lot of these real estate deals to buy are dealing with a less sophisticated investor who doesn't understand it and probably thinks that they can just redeem their shares, their $1,000 investment for face value, $1,000 at any given whim. And so that's going to challenge the entire partnership, because now this fund manager is getting calls from this guy's ambulance chasing attorney saying, I want my $1,000 back, and he's not doing what he should be doing, which is operating the asset, managing the investment. That's where I see a lot of problems come in. People with short money always have, they don't bring any value to the deal. They actually take value from the deal. Does that make sense?
Just a reminder, you're listening to Flashback Friday. Our new episodes are published every Monday and every Wednesday. People with short money, you said?
Yeah, it's a term. People who don't have a lot of money, people with small balance investors like this, micro balance investors, those are the people who you do not want to be partners with in an investment.
Okay. Like if you're the bigger investor, or if you're any investor, maybe you're a crowdfunding investor that put in $1,000 also. I mean, I can't imagine, though, it cost $1,000 per investor. Like, say someone's raising $300,000 to invest in a deal. Can they take on 300 investors at $1,000 each?
That's way too many.
Yeah. Well, no. I know that's a lot to manage an investor relations problem, which is what I want to ask you about. But I don't even know if that's legal under the crowdfunding laws to have that many. They just changed again, and now I'm not totally up to date on the new change, because now you can do non-accredited investors.
Correct. So, and that makes it even worse now. So, when you're for me, when I've done this, when we've had at one time in any one deal, we've had 32 LPs, limited partners or investors. To do the K1s and everything, it would take, it costs money to do that.
Yeah, there's a lot of accounting and compliance. I agree.
Oh, absolutely. But that is, at the smaller investment increments, it doesn't make sense to do that.
So you don't want to be partners with the small investors, you're saying. And what do you consider small? I mean, if, a lot of these crowdfunding sites will say, well, you got to put in $5,000 per person.
That's still too small. I would say $50,000. If you're investing alongside other people who don't have the same financial strength as you, that's a problem. That's going to be a problem. And, one of the things that our investors, who, again, are a little more sophisticated, will say, for one of our latest offerings is that we don't want anyone coming in for less than $250,000. Otherwise, I'm in violation of the operating agreement, and I can get sued for that. So, the smart money knows how to pull the strings, because they don't want me having the burden with dealing with so many investors. It could become a nightmare, like you said before. And that's the problem. When you're dealing with sophisticated investors, they know that it's real estate. You can't sell it. And they're also not buying a lottery ticket, too, which I think, unfortunately, a lot of these crowd investors do, is that they just go out there and they start, dreaming that, that is more like a Shark Tank episode, that they're going to hit the lottery, and it's not a steady Eddie coupon clipping type of investment.
Yeah, and I agree with you. I think some of these funds and some of the people taking advantage of all of these crowdfunding laws, they're basically like a version of the modern casino, where they're just going to take money. They're just going to be ripping off small investors, people. It's so desperate. You go to these casinos, and I can't believe this crap is legal. They're just destroying people's lives. It's so sad. All these poor people sitting there at slot machines, a lot of them elderly, this is just disgusting what these companies are allowed to do. It really is.
Well, you can thank the Fed Reserve for this, because they've actually have had the zero rate interest rate policy, ZIRP, NERP, negative interest rate policy. Banks in Australia now are going to be charging you money to hold for the privilege
I know,
of holding
and Germany too.
It happened in Germany
it's
already.
Negative interest rates. Yeah.
So people are desperate. And that's the drive. The Fed is desperate to have people take risks.
I'm glad you said that and recognized it. And let me just elaborate on that, and you can finish my thought here for the listeners. But what he's saying, listeners, is that because of this environment, because we have these greedy, disgusting central banking scams, okay, what they've done is they've created this no-yield environment. And older people specifically, they get burned the most because they're the people who did the right thing. They saved money all their life. They were prudent. They didn't, they delayed gratification, and then they retire. They've got a few bucks, and they think they can just live off their money by putting it in a really conservative bond or, a savings account or a CD, and they can ladder those CDs and they can live decently. Now, granted, that's not a very good investment plan, obviously, but, this is what a lot of the world planned on. And because there's no yield out there to get from these really safe things, all these people have been pushed into the risk arena. And they shouldn't be taking risk. So is that what you meant to say?
Absolutely, 100%. You hit the nail on the head. Yes. No, you did. And you know what? Being a money manager, being the cynical guy that I am.
I think you're an honest guy. I like what you say.
No, but I look at everything cynically, and that's how as an investor, you can't, look at everything through rose-colored glasses. You have to see what the risk is and structure it away. But this money manager's view is that rates will not increase anytime soon. Probably not in your lifetime, Jason.
Right. Yeah. Wow. So you think we are just in a low-rate environment for the duration, huh?
Exactly, because there's no catalyst for rates to go up.
Well, come on, you kidding? With all this debt we have, you don't think inflation is going to come? Wow.
I could be wrong, but it's not just my view, but a lot of people. And if you see how these bonds trade and everything, they have the same view too as well. The problem is that people keep buying treasuries, and as long as because there's an implied safety with the United States, and you have all this money just going into treasuries because there's no real place for it to go. America is still a great place for rich people to invest, politically stable, all of that. But when you start seeing the yields, I mean, the 2-year drop below, a two handle at one point. I mean, this is just really ridiculous. And so that is what's happening. And I think the market mechanism, as you knew it, doesn't exist anymore for price discovery. Everything is manipulated, and everything is really a function of someone governing the markets, not the markets governing themselves, if that makes sense.
Right. And see, that's what happened during the last crisis. We couldn't have, and I would argue that we still don't have price discovery because everything, when you've got all this, everybody's trying to make predictions, but you can't make predictions in an era of massive intervention by governments and central banks. They completely screw up the market, and it's just very hard to predict anything, I don't think the economy itself is really, like incredibly hard to predict, the business cycle, things like that. But when you get all this intervention, you can't predict a thing.
You can't. Yeah. And that's the problem. And now, different capital sources have different needs. My apartment was sold. We sold my condo in New York. I wanted to buy a new one. The guy who bought it was someone from Brazil, didn't speak a lick of English. He just showed up with a briefcase literally full of cash, and he offered over asking price because for him, he's using real estate as a wealth protection vehicle. He doesn't care. He doesn't care if he overpays or not. He's hiding money. And that's a whole other conversation we can have.
I'm glad that's happening, though, because that does show you that much of the world, as messed up as America is, still looks at America as what's called the Brinks truck. It's the safe place to put your money. And because, we do to some extent have rule of law, except when it comes to government and lobbyists and central banks. They don't have to obey the law. And Wall Street doesn't obey the law either, because they basically own the government. See, I'm pretty cynical too.
Yeah, and that's the mindset you need to have today to be a successful investor. And that's what people don't understand.
Okay, so what else about crowdfunding? Other thoughts on that?
I think we'll see what happens with it. But I think when people, you got to check the bios of these people. The first thing I always ask is somebody's looking for money from me. We're discretionary, right? We're not a bank, so we don't care about their credit. We care about the asset. That's what a discretionary capital provider does. You want to buy a retail center, you have experience, and you can show a bio and a deal sheet of stuff you've done. It's almost certain that you're going to get a loan from us. But if you don't have any experience, you're not going to get a loan from us because, we are not in the business of teaching you and becoming the research and development for you to learn how to piece together a retail deal. or a value-added multifamily deal. So I would look, if any, there are some, I'm sure there's some good crowdfunding things that are working, but the two things I would check is what's the minimum investment, how many of those investors are in on that floor, that threshold, the smaller money. That's what you want to move away from, because that means that the operator is desperate. And, because the smart money is turning them down, but the stupid money, which is always unfortunately the unsophisticated money, with the less dollars, the shorter money that we talked about before, he's opening the floodgates for the masses to come in, and that's where the problem is.
But the smart money will be glad to be in on that deal as long as they don't pay the rack rate that the stupid money is paying. So again, like you said, and that was so well put, that they're using this smart money as it's a head fake. Because it makes you think that, oh, well, this deal's been vetted. All the smart people are in it, so I'm going to go into. I mean, look at Bernie Madoff did that for decades. He made a career out of that. And you know what blows my mind, though, is, hey, look, and I'm gonna call you out for a second here. Feel free to debate me. But you're saying check the guy's resumes, right? You gotta be kidding me, though, because look at the resumes of Bernie Madoff. Bernie Madoff was president of NASDAQ. I mean, he was networked in every country club, in all the highest level circles. But wait, there's more. Look at John Corzine. He was frickin' governor of New Jersey. Okay.
He was also my ex-boss too. I know.
Oh, was he really? Okay. Yeah, and he ripped a bunch of people off, and nothing's going to happen to him, probably, right?
Yeah, they're invisible. You're right, but I think that when you're talking about John Corzine, you're talking about like these bond trading funds, these real hedge funds. I know that word is abused today. And what he did was he took a lot of risk with other people's money that was supposed to be segregated. You're right with the experience. You're absolutely right. But I think you're going to see a lot of fraud because people are just so desperate. Pensioners and savers need to put money. They need a return. They're desperate for yield. That's why I named the book Making the Yield. It's for someone who wants to get into this business and learn to make direct loans. This is your gateway drug to do that, and to do that efficiently. And it's basically off of all my years' experience, seeing everything that's gone bad. But there are some people, and that's just the way the money management industry is. But the SEC, though, is not in a hurry to prosecute a lot of these people. I think they're underfunded. I don't think they have the sophistication. They're just not going to be chasing after a lot of people, I think. I think they choose their fights, and they choose them, the lowest hanging fruit. When you see the more sophisticated frauds, it's sort of like the John Corzine. He's still free. He's still out there. He got a hand slap maybe, but, nothing really is going to happen to that guy because, well, he's very politically connected too, which is something that, we forgot to mention.
Mm-hmm. Oh yeah, no, of course. I mean, it's all political. I mean, all of this stuff gets political, and that's the problem. The little guy doesn't have any political power, so he's going to get nailed. Well, the big guy, it's like too big to fail. If you rip a lot of people off and you do it on a really big scale, or if you have connections in some way, there's a good chance you're going to get a pass. Okay, so you can go out and commit your frauds with impunity, or your indiscretions. And another thing that just blows my mind is the way that like these funds, they're all set up in Delaware. In Delaware, for its share, I mean, it has good business practices and it's business friendly. That's why all the businesses are there, right? And there are other business havens too. But one of the things in Delaware that you can do is you can contract away your fiduciary obligation. So you can just say, hey, I don't owe you anything as an investor. I mean, that doesn't seem right to me.
Yeah, I mean, you're more sophisticated than the rest of the guys, but you're hitting the nail on the head. Exactly. And that's usually what happens.
I learned that because there's this company in Phoenix called Caliber. And, they got a bunch of funds out there now, and we've done some deals with them, didn't have very good experiences at all. The first thing he says is, oh, well, we put them in Delaware because then, we don't have to be liable. I'm like, oh, wonderful. I'm really going to rush to invest with you guys again.
I mean, that's not blazingly honest.
They brag about this stuff. It blows my mind,
I think really what we're reaching, I think, right now, the golden age for if people really do want to pool money to invest in real estate, this is the time to do it. This is the golden age. for that.
Well, I kind of thought you were just saying it wasn't. Isn't that the crux of this conversation? Okay.
No, it is the golden. No, it is if you do it correctly. If you're pooling $1,000, $500 chunks from smaller investors, that's not going to work. But as far as people like you, the more sophisticated guys, and you have a good track record and you have good ethics, you're going to be very successful. And we're seeing that happen right now. People are buying apartment complexes. These little REITs are popping up all over the place, and they're just people who, they don't have to go to the bank anymore. They'd rather go, to the guy down the street who has a self-directed IRA with $500,000, to fund his deals. That's where you're starting to see it right now. Is that it's taking on more, and really what people want, and the alert of this is that people want more intimate money management. People who invest with you know you, they have your cell phone number, they see the asset, they can kick it, they can, touch it, feel it, spit on it. But conversely, and you got to put yourself in the mind of the investor now, the saver, the pensioner, who's a loser, not morally or ethically, but they're just losing money. We haven't even talked about inflation with that, but they're just losing money by having it sit in the bank. They're like, well, I'm going to invest with this guy rather than put it into Martha Stewart on the media. If I buy 200 shares of Martha Stewart, guess what happens? If she does something stupid again, insider trading, goes to jail, that stock will drop probably 50%, but they have no control over the investment. And that's what people really want today, is that they want control over the investment. Good luck calling Martha on her cell phone and asking her why your 200 shares dropped 50%. There's not a chance in hell you're going to get her on the phone. But what people's main attraction to is, I want something that I can see, touch, feel, and understand. I don't understand the stock market.
For my part, and listen, I agree with you, and that is good that it's more intimate and it's getting closer to the investor and the man. They can really talk to the management, and that's good. That's an improvement for sure. But for my part, I say for most people, just buy some single family homes and rent them out, and you'll make money, and that's your retirement. I mean, that may be really your big wealth creator. You can move up. You can move up and buy your own apartment building or buy it with a partner rather than, having some fund manager that's skimming the profits off the top of the deal.
Oh, no, absolutely. But there are people who think that there's an allure, and I'm one of them. And I don't want to cut my nose off to spite my face, but I'm wearing two hats here. And, the point is I've seen some funds that are very well managed, and I've seen some that are not. There was a company in Phoenix, I can't remember, but they blew up because they overpaid for everything. And then the banks called the loans due. So.
See, that's the thing. When what I'd like to see is the fund manager having a lot of their own money in the deal.
That you always have to do that. You always have to ask, and that's what comes down to the alignment of interest. And in the institutional world, it goes like this. Well, if I get hurt, I want to make sure you get hurt too. And that's really what it is. And so, I've been in some tenuous conversations in some institutions here in New York with, people who I know. They said, okay, what are you putting in? I'm putting in a fresh one, fresh million or something, and where's that money coming from? Is it coming from you, or is it coming from your brother-in-law, or from people who you don't know? And not all equity is the same. And, people sometimes will say, oh, well, it's my money. Is it really your money, or is it your mother-in-law's money? That could be considered your money because you never want to lose your mother-in-law's money. But if it's being pooled from people who you have no idea who they are, you have absolutely no alignment of interest with your investors. And that makes it so that you can walk away. That's the hard questions that you have to ask. And that's what investors don't ask, is that they never ask the hard questions. But you're absolutely right. You got to have the proverbial skin in the game, because they want to know that you have your feet to the fire. And that's how grown-up deals are done. Now, it's not bad to raise money and syndicate money for bigger deals like that. But, again, putting on my investor hat, this is what I would want to see is, okay, I'm going to invest in this guy, Sal. What's he got into it, and where's it coming from?
But here's the thing. I just want to point this out because, Sal, you brought this up before when you talked about the rack rate issue, right? A lot of these guys, they're in the deal, and what the investors, it's so hard to sort through and really understand the capital structure on these deals and the alignments of interest because, they're in the deal, but, they don't pay the rack rate a lot of times.
Oh, that's a whole other story. I mean, these syndications sometimes, that blew up, and this is what we would fund these, we would provide triage financing for this, is not all equity is the same. So I remember one time some guy came to me and he had a deal. I'm like, so where are you in the capital structure? Where are you in the cap stack? well, I'm common, but I'm treated like preferred. I said, no. That's not how it works. That's not how it works. There's remedies for different parts of the capital structure. And, this guy is saying, well, but they treat me like preferred, but I'm common. I said, no, that's like the girlfriend saying at her rich boyfriend's funeral when they're reading the will that she deserves to get the millions of dollars and not the wife sitting next to her because he called me his wifey or something. It's totally different. And that's why people, I actually wrote a book on this that I'm finishing up, but it's important to know where you are in the capital structure. What are your rights and remedies? And people don't ask that question. They don't. Sometimes they don't even know what they're getting. Sometimes they have I've seen investors offer what's called a cash flow certificate. That means nothing to me because there's no recourse and no remedies. But you hit the nail on the head right there.
Yeah. Good stuff. Sal, this is really informative. And, in this world in which you operate every day and you see all this stuff, I want to just thank you for sharing this with our listeners because there are just so many scams and, some of them don't rise to the level of being a true scam. They're just, people who have their hand in the cookie jar.
They're asset aggregators and they make money by sitting on assets. That's what they do. They make money on sitting on assets. That's what they do.
And they make money because, they got the management deal over here and they got the rehabber, the contractor company over here. And, they're like triple dipping and all of these, they're referring the business to themselves. It's self-referential, so once they get control of that money and control of that deal, they say, hey, well, my contracting company will just rehab the apartment building and then my management company will manage it. But all the investors got to pay for management on site too. That's what we found this Caliber company doing. When confronted with it, they just made kind of excuses, sort of says that's the way it is, tough,
Yeah, but to the uneducated investor, they're like, oh, cool, he's fully integrated, oh, this is great, he can take care of everything. Not so fast. You're absolutely right. Always read the fee agreements too, and if anybody's thinking about getting into these things. What are the fee agreements? There should be a 1% flat rate in most real estate deals. That's acceptable. That's fine. And the reason for that is because the investors want to make sure that you're keeping the lights on. They don't want you to have to go outside of investing and managing their money to make money to keep the lights on. Anything more, I've seen them as high as 5%, 10%. Why? I don't, and that just shouts inexperience to me. They show their true colors.
Yeah, wow, just 5 and 10% versus 1%. that's realize that that's not a 4 or a 9% increase. That's a 500 or 1,000% increase. It's a multiple of 5 or 10 times. That's insanity.
But people pay it because they're desperate. They're desperate.
They're desperate and they're busy and they don't have the skills or the ability to evaluate all these things, So it's a sad story. It goes back to that casino analogy, and I agree with pretty much everything you've shared with us today. Sal, give out your website.
Yeah, for people who are listening on this, we're giving away. We have 20 books that we're going to give away for free, print copies of the book, and they can go to makingtheyield.com. And there's a little video there, and I talk a little bit, but you can go to makingtheyield.com, and if you're one of the first 20, we'll ship you a book out. All we ask is a couple bucks for shipping and handling. I think it's like $3 or $4 or something like that. But there's also a lot of other cool stuff on there too, like infographics and how these funds should work and all sorts of other things that'll really open your eyes as to whether or not you're being played or not. It's sort of like that old adage if you're playing poker and you can't tell who the fool is at the table, it's probably you.
It's you, yeah.
This to get people smart. We call it intellectual capital. And, that's the sexy term in the industry. On Wall Street, they'll say, does this guy have the intellectual, capital to pull this deal off? That's really what it comes down to. But if you go to makingtheyield.com, first 20 get a copy of the book.
Okay, so get a free book at makingtheyield.com. And Salvatore, thank you so much for joining us today. This was very, very enlightening, Sal.
My pleasure. Anytime. I really enjoyed this. Thank you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.